Insider credit scoring secrets. There are 3 credit reporting agencies, so therefore you'll have 3 credit scores. Your credit score is a reflection of how much of a risk you are to lend to. Credit scores range from 300 to 850. The higher your score, the more favorable you are in the eyes of a lender. Scores above 720 are considered excellent, and scores below 640 are below average. Now, mortgage credit repair scores are much different than a credit card pull or other type of financing score. You can have your credit pulled by a car dealer, credit card issuer, and mortgage company, and you'll have 3 different scores, the mortgage score being the lowest of the 3. That's because there's a lot more risk involved in mortgage lending than, say, an auto loan or a credit card. Mortgage lenders will use your middle score of the 3 credit bureaus. Obviously, the higher your score, the better chances of getting favorable loan terms. Credit scores are determined by many variables. I'm just going to give you the top 5. Here they are. 1. Payment history. How well you pay your creditors weighs most heavily on determining your score. On time means not being over 30 days late. Credit bureaus only count you late if you're over 30 days. 2. The second biggest factor is the balance you owe on your revolving accounts. Revolving accounts are credit cards or lines of credit, for example. Having a balance is not enough to negatively affect your credit. It's more of the percentage of your credit limit being used. So, for example, if you have a $5,000 credit limit on your credit card and you owe $5,000, then that's going to negatively affect your credit score. The closer you are to your limit, the more negatively it affects it. Ideally, you want to be at 1/3 of your credit limit or less. 3. The third main factor is length of history. The longer you've had credit established, the more favorably your score will be. 4. Opening new accounts. Accounts opened up less than a year ago will usually have a negative impact. There are some exceptions, such as an auto loan or mortgage loan. These accounts impact you less if they are less than a year old. 5. The least important factor is type of accounts. Out of all types of credit, department store cards are the worst in terms of helping your score. Here's some common myths about credit scoring. Amount of debt. The amount of debt that shows on your credit report has no bearing on your score. Credit reports carry no information on your income to debt ratio. Bad credit stays on my credit report and hurts my score for 7 years. Yes and no. Credit history does not stay on your credit for more than 7 years, but credit scoring puts a lot of weight on the most recent years. So if you've had some late payments from 4 to 5 years ago, it's not going to make much of an impact on your score.